Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in my regular Wednesday episodes, I talk about the theories, methodologies and principles associated with investing. The aim of these case study episodes is to demonstrate how it works out in real life by giving you a bit of a profile of one of my clients that I might have been working with over the past number of years. And this is another good one. I think the results are pretty good. We started working with the client, $60,000 of investment assets has now ballooned to about 1.6 million of investment assets after sort of 8 or so years of working together. But a lot has happened over that period of time, and there's been a lot of advice given to the client. So, as I said, we started working in around mid 2016. So it's about 8 years ago. The clients were in their late 20s at the time, and they were just starting out. And at that stage, certainly from our business perspective, it was actually kind of economical. Well, maybe the economics were questionable from a business perspective, but it was a lot easier to work with clients that are just starting out, which means that you could have what's called sort of scalable advice, which allowed us then to charge lower fees given they had a relatively simplistic situation. For reasons I think I've spoken about before in the standard episodes around sort of giving you commentary on what's happened with financial advice, we just unfortunately can't do that anymore, which is a real pain in the neck because I kind of really like working with clients that are just starting out, that are thirsty for good quality advice and help them grow. And hopefully this case study is a perfect example of that, I think, and really does demonstrate the value of getting it right from the start. And certainly these clients have seen a lot of value in the advice that we've given. Okay, so that's a bit of a sidebar really, but let's return to where they started. So again, back in mid-2016, started working together. They really didn't have a lot in terms of net worth, about $160,000 of equity. The value of that home was $400,000, had a home loan of $380 and $140,000 in the offset account. Now the $140,000 in the offset account obviously was a clear sign that they had a bit of cash flow, surplus cash flow and ability to save. Had about $60,000 in total super together. I said they were just in their late 20s, about $100,000 of HECS debt because the female was a dentist, just qualified as a dentist or qualified a few years ago. And so she was earning about $190,000. He was earning about $55,000. So I would say they're not tiny incomes. So I'd say relatively modest incomes to start a financial planning relationship. As I said, unfortunately, we probably wouldn't be economical for us to do it at this stage. Although, as I spoke about in the last Q&A podcast, if you do take a long-term view, and I guess value is in the eye of the beholder, I think this is a good case study to demonstrate, well, actually, it was well worth them paying for advice, even if they had to pay today's fees to get it. Okay, so where are they now? So they're in a substantially different position now. More than $3 million net worth, $1.6 million of investment assets. The largest contributor to that was property, business equity, and then shares and super. So to give you a rundown where they are now, they've got a home, but also during COVID, they bought some vacant land in a very sort of unique parcel or area, I should say, that was in kind of high demand, possibly overpaid for it. But I'll kind of come back to that later on. So if you look at, and they're going to construct eventually. So if you look at the value of their home and that land, it's about 1.7 with about $300,000 of net debt. So they did borrow quite a lot, about $1 million to buy that land, but they've been able to use their cash flow to sort of repay their debt. So got quite a bit of equity in, let's call them lifestyle assets, home and vacant land. They've got a investment property, an apartment in Melbourne, purchased in 2016 for about $470,000. Again, that budget was set in 2016 when they had relatively conservative levels of income. There's virtually no equity in that apartment. It hasn't really done very much at all over the last 8 years, which is not unusual for that asset class. I guess if we had our time again, would have we bought in that sector? Well, probably not. But I think certainly I have a bit more of a better insight into market sort of points in cycles and being a bit more strategic around that today than was. Lesson learned, I guess. In the long run, that investment will work. And just in regards to that, of course, we all get better at what we do over time, and that's kind of one of the reasons why you pay for advice. But hopefully 10 years from now, I'll be even better at what I'm doing than what I'm doing today. Well, I mean, a good example. So in 2019, we bought a house in Brisbane for about 820,000. That'll be worth 1.6 now. So it's doubled in value over that very relatively short period of time. About 900,000 of debt. So we've got about $700,000 of equity. So I think I look at those two acquisitions, one in 16 and one in 19. A lot happened between 16 and 19 in terms of, the amount of time that I spent and thinking about, property investing and market cycles and so forth. So one tick and one cross. I think they're both ticks in the long run, but at least as we call it today. Now, we helped the client buy her own dental practice at the beginning of 2022. I'll come back to that in terms of the process around that. But that's obviously improved in value, maybe about $400,000 of equity in that. We've been investing over the last sort of year, I think. I have some notes on this. 18 months into a corporate beneficiary, so we've got about $130,000 of kind of share equity portfolio, and then we've got about $340,000 of super. Now, the client's income increased substantially as a result of buying that practice, so her income's now sort of circa $750,000, which is a lot different to what she was earning as an associate dentist, of course. So we've helped them over the time buy a couple of investment properties, purchase a dental surgery. Of course, there's a lot of sort of due diligence, financing, structuring around that. And in fact, there was a lot involved with respect to that in terms of where that dental practice should be purchased. How did it fit into the longer term plan? Was it going to retard their ability or actually improve their ability to sort of achieve their financial goals? And so there's quite a bit in that. And I think for people that are in professions that sort of lend themselves to being self-employed down the track, and that's kind of the goal, that can be a really big factor to take into account when building out a long-term investment strategy. It helped them invest in super, of course, and improve that. And as I said, the corporate beneficiary in investing in the share market started 18 months ago. And then, as I said, we purchased some vacant land during COVID. Again, that's kind of their forever home. And we did a bit of work around, well, what happens if we put a lot of money into this asset? So land was expensive, of course. To go and construct a home will be expensive. What's the impact with respect to potentially overcapitalizing or putting a lot of wealth into a particular asset that may not have a lot of capital growth prospects? And we sort of work through that. So, I mean, again, building a long-term financial plan. I talk a little bit of this in the standard sort of podcasts, but it is a sort of balance between, making sure we've got that long-term plan and we're going to be in a secure financial position, but also then that gives us a good context for measuring whether we can achieve some of these lifestyle goals. And it can be quite empowering for clients to be in a position to know, hey, I can take this step. It's a really important lifestyle goal for me. I acknowledge that the financial outcomes may not be perfect, but it's affordable and I'm on the right track and I'm going to feel comfortable doing it. It can be really empowering to be able to put a client in that position. Okay, so as you know, I like to sort of reflect what are the kind of key learnings I think we can take away from, the work over the last 8 years with these clients. So I think the first thing is, and as I was talked about at the beginning of the episode, getting the foundations correct is actually important and really valuable, but it's a really interesting discussion. I actually saw a discussion on LinkedIn regarding the value of advice, and a lot of advisors saying, well, it's really hard to justify the value when a client doesn't have substantial assets. So in this situation, this case study situation in 2016, the client didn't have substantial assets. They're really good at saving. So they had good cash flow and good cash flow management. And you could see that, from an income perspective, if she implemented a plan to buy her own practice, you could see over the next 10 years, there was going to be a lot of investable income, but as it stood back in mid-2016, it's hard to really justify the value of advice. Now, I'm sure this client, I haven't asked her, I should, I'm sure this client would look back and go, well, that was a valuable experience. Even if she had to pay what our fees are today, $50,000 over the last 8 years or whatever it might have been, I'm sure the client would say, yeah, that's good value. We've achieved a lot over that period of time. Even the tax structuring around the business and making sure we've got a coherent tax structure to invest those monies tax effectively and build wealth and all those sorts of things, cash flow allocation, investment advice. I'm sure the client would look back and go, that's a no-brainer. But it is difficult to justify as a financial advisor. So if someone comes through the door and says, Stuart, I've got $3 million, can you look after it? I can say, well, whether you earn 7% or 7.5% on that money over the next 20 years is a huge difference, huge compounding difference. So yeah, I think we can justify, the need for advice. It is a lot more difficult when, as I said, the client doesn't have a lot of money, but doesn't necessarily mean that there's no value there, I guess, to some degree. Value is in the eye of the beholder, and price is what you pay, value is what you receive. The second point is that I did spend a lot of time around the discussion around the dental surgery acquisition, and it's been something that's kind of been on the plate or on the table, I should say, for the last couple of years before we went and purchased in 22. So we're probably talking about it since 19. And just making sure that, look, are they going to stay in that particular location long term, where they're currently living, what sort of practice they want to buy, a couple of different opportunities, and then how did it fit into that longer term plan. So again, for people that are going to become self-employed in the future, that can be a really valuable thing to make sure it does integrate into the long-term plan. Getting the foundations right, doing that initial investing proved to be put the clients in a really good position. So, we bedded down the investment property acquisitions, the purchase of the dental surgery, and then started, making sure we're maximizing super and putting some money in a corporate beneficiary. All those things were bedded down when then the client turned her attention to, well, should we buy this vacant land now in this pocket that has water views, in fact, that we'd like to live in? And if they hadn't have done all that hard work previously and bedded down that strategy, get the financial assets working hard, it would have been a more difficult decision. But getting those basics right, I think, puts you in a position where then you can start prioritizing lifestyle concerns or goals rather than financial outcomes. Now, in terms of the future, I reckon the next step for this client's probably buying the dental surgery, whether it's the one she's currently in or another sort of commercial property or residential property that we can convert, and probably putting that in a self-managed super fund. I imagine that's sort of the next natural steps. That's something that we're going to help her with and talking to her about. We're not doing that yet because I don't think it's economical to do it, but it is on the cards. Continuing to carve off that profit. Now, the last couple of years she's been spending on reducing that debt with the vacant land, and now we can focus a little bit more on share investing. So they're going to be in a fantastic financial position. They're already in a fantastic financial position, but they will be in the future as well. And I thought it was a really good case study because it does show that, even if you don't have a lot of assets, and I don't want to talk about this too much because you've got to be in a position as an advisor where you can hold hand on heart. It is absolutely worthwhile you paying for advice. That's our approach, which means that we say no to a lot more clients that we say yes to. But it is an interesting example. And I think if the laws were changed to accommodate the industry in its current form, because the financial planning laws were written 30 years ago when there was a lot of commissions involved and so forth, they need to be thrown out the door and rewritten so that they accommodate and still protect people, but that's appropriate for the industry as it currently stands. That would open up our ability to help a lot more clients, just like we've helped these clients I've spoken about today. Look, I'll get off my soapbox, but that's the main point of this case study episode, I think, is that there's a lot of things that happen to us over life, and particularly as we're younger and we're starting out a career and we buy our first home and then we upgrade and then we invest in property and then we're contributing more to super and then we've got a greater investable cash flow. All these things happen over a relatively short period of time, a decade, and it gives us plenty of opportunities to make sure that we're making the right decisions at that particular point in time. Anyway, hopefully this podcast goes a long way to helping you make some good quality financial decisions. Okay, let's get into some listener questions. Okay, the first one is from Mike and gives me some positive feedback about the podcast. And I'll read all this feedback, by the way. I really appreciate it. I won't repeat it with every question, but I do appreciate receiving your positive feedback. Anyway, Mike writes, I've heard you talk about using a mix of leverage and savings to invest in ETFs. I'm wondering, is there any way that can be done so it pays for itself, neutrally geared? Just using the example of, say, matching a $1,000 equity loan with $1,000 of savings, you could use a split of high-yielding ETFs with growth. I see Vanguard high yielding is averaging 4% return, so still not enough to cover borrowings. Hope it doesn't delve too much in the realms of specific advice. No, Mike, it doesn't. So what I'm talking about here, or what I was talking about here, is regular share investing. So investing a certain amount each month into the share market, obviously spreading across a couple of different ETFs, or probably better using a diversified ETF like Vanguard or BetaShares have diversified ETFs that spread the money across the Australian market, international markets, often smaller companies and emerging markets and so forth. And they manage that asset allocation. You don't need to worry about that. And my idea is that, exactly like Mike suggests, that instead of investing, you've got $1,000 a month to invest, why don't you go and borrow another $1,000 and invest $2,000 a month? So 50% from your cash flow and 50% is from borrowings. Now, the way we look at it is that long term, you probably expect around about 3.5% in income from a diversified investment. Now, remember that some of that will be dividend income. Some of it will be, a small amount will be realized gains if there's sort of changes in indexes and so forth and they realize gains. Some of it will be from hedging profits as well. So some in those diversified ETFs, they have some hedging and that throws off some income as well sometimes. So around 3.5% is reasonable, I think, on a long-term basis. Not going to happen every year, potentially. Some years it's going to be 5%, in fact, so a little bit predictable. So if it's 3.5%, it means that if you're gearing at a 50-50 ratio and your interest rate is 7% or less, then you should be roughly neutrally geared. Certainly 40% of gearing would achieve that. So if you're investing $1,000 of your own money, your savings, then borrowing, say, $650 and therefore investing $1,650 per month, that'll give you a 40% gearing ratio. That'll almost always ensure that your portfolio is positive cash flow. Now, I wouldn't skew towards income too much, so I wouldn't say, well, I want this to be positive cash flow, so I'm going to skew my investments to sectors or types of ETFs that throw off more income. I wouldn't do that because that could come at the cost of longer term capital growth and also come at the cost of really ultimately maximizing your longer term returns, which is kind of the goal. So I wouldn't back it in. I'd decide what I wanted to invest in, how I wanted my portfolio to work, and then I would reverse engineer it to work out, okay, then what gearing ratio can I afford to take in order to make that work? And that the answer is likely to be somewhere between 30 and 50% for most people. But thanks for your question, Mike. That's a really good one. Okay, next question is from Leah. Leah writes, one of your recent podcasts about top performing super funds in 2024, you gave us an opinion of a few super funds, which is helpful. I've got a question about what should you consider before switching to a super fund. Bit of background, I'm 37 years old with a balanced investment in Australian super. I'm thinking of switching to high growth with UniSuper. Are there any tax implications in switching, like CGT? And as the market volatility now is relatively high, is switching now a good time, or should I wait until the market goes down? And Leah, look, I've got a lot of questions to answer. It's possibly you wrote that question when the market volatility was high. I would say it's sort of below trend at the moment. Let me answer your questions. What are the things to consider? No, there's no capital gains tax because any provision for unrealized capital gains is taken out of the daily unit price. It's kind of one of the negatives with a pooled superannuation product like an industry super fund. And in fact, I'm going to write a detailed blog on wrap platforms as an alternative. That's on the cards. It's just going to be a big job, so I've kind of keep procrastinating on it, but I will get to it over the next couple of weeks. So you don't need to worry about tax. Time out of the market is negligible. So one of the risks is that when you switch, what will happen is Australian Super will sell your balance and move that balance, transfer it over to UniSuper. And if that takes, let's say that takes a couple of weeks to happen, the market could appreciate over that time and you miss out on that uplift, or the market could crash and then you get to buy in at a much lower rate. The answer is you can't really control it and you shouldn't really worry about it. With SuperStream now, all rollovers go through an electronic clearinghouse to make things a lot smoother. And so with SuperStream, super gets transferred really quickly. Your time out of the market might literally be 1 or 2 days. And so whatever changes on that day, you will miss out on. That could benefit you or could hurt you. There's nothing you can do about it. Wouldn't worry about that. The next thing to consider is insurances. Now, you said you're 37, so you might have some insurances in your super. So I'm talking about life, TPD, income, salary continuance, or income protection, depending on what it's called. What happens is, or the best thing you should do is replace those insurances before you close your account. So in order to do that, because the risk is that if you roll over and for whatever reason, the new fund, your new super doesn't give you insurance, you might actually regret transferring. So what we typically do in that situation is we would establish an account at UniSuper, roll over $10,000 or some nominal amount of balance, apply for the required insurance cover, which might be just to replace whatever cover you have in Australian Super or whatever you think is appropriate. When that cover is approved and in force and in place, you would then close the Australian Super account and transfer the remaining part of your balance. If you apply for the insurance and it's declined, well, at least then you could say, well, you know what? I'm going to move back to Australian Super and then close that Uni Super account. But insurance is something to think about. And last consideration is, look, sometimes some employers have arrangements with different industry funds to pay certain fees or subsidised fees or something like that. So that's something to think about, whether you're just getting the stock standard sort of rates and fees or whether there's something special that might be related to your employment or industry. It's worthwhile checking. Now, that's not advice, of course, because that's one thing with super is there's always differences and uniquenesses and, you've got to be kind of on top of it. I would say generally that's, 99% of it, but they're the sorts of things that you'd consider. I hope that helps you, Leah. Thanks so much for your question. Okay, another great question. This is from Zach. Zach has a primary place of residence with about $650,000 of debt. The home's worth 1.1. Zach's also got an investment property. He says it's got $650,000 of equity and is positive cash flow, which means the rent covers all the repayments and costs. Doesn't tell me what the debt and value is of that property. Anyway, Zach writes, I'm in the process of purchasing another investment property. It will be negative cash flow. I would like to sell the first investment property, and that would allow me to fully offset my home loan and therefore have no non-tax deductible debt. Of course, I would need to pay capital gains tax to do that. Zach asks, is that a waste of money given the fact that he's going to have to pay capital gains tax and he's going to have to pay selling costs, agent commissions and so forth? He goes on to say, my wife and I are very frugal and we do not need the cash flow with my income. However, the amount of non-deductible debt we have isn't ideal. I'm 29 and my wife is 35. Household income is $300,000, one baby with $75,000 cash sitting in an emergency fund in an offset account. So, Zach, great question. Let's summarize it. Should you sell your investment property to allow you to reduce your home loan to zero? My answer is no. In your situation, based on everything you've told me, of course. Again, this is not specific financial advice. I can only go on what you've told me, but that's the whole point about a Q&A podcast episode, of course. So you've said your home loan's $650 relative to your family income of $300,000, and you're in your sort of early to mid 30s. I know your wife's a little bit older than you. So it's not a big deal, right? You're going to repay that home loan. It's very manageable. You're probably not that sensitive to interest rates, at least from your home loan perspective. And you've got a huge long runway to get rid of that home loan. Now think of it this way. What will the investment property, you said the investment property has $650,000 of equity in it. Didn't tell me the value, but I assume the value is north of $1 million. What do you think that asset's going to be worth in 20 years' time? Well, if you get about around 7% capital growth, it's going to be worth $4 million, because it's doubled a couple of times. So it's another $3 million of equity. So I think repaying the home loan probably feels nice. It's kind of a bit of an emotional decision. Be great to be in a position where you don't have that non-deductible debt. It's everyone's goal. I can tell you the day that I had no non-tax deductible debt, I was pretty happy about it. You forget about it pretty quickly though. Anyway, the point is, what decision can you make today so that when you look back in 20 years' time, you'll feel confident about that decision? And I can say with a relatively high level of confidence, unless the property is a complete dud, you're probably going to look back and go, well, thank God I kept the property because I've got $3 million more equity, even if it's only $2 million, and I've subsequently repaid my home loan anyway. You said you're pretty frugal with cash flow, so you're managing cash flow well. It's not going to be an issue. I would hate to see you crystallize a capital gain, pay that money to the ATO. It's a donation they don't really need, and then you're worse off. And the only reason that you're doing it is to get rid of that non-tax deductible debt that doesn't really provide too much of an impost in terms of cash flow or interest rate exposure. So no is the answer there, Zach, but good question. Okay, final question now is from Mark. And Mark refers to episode 316, where I talked about the 6 important considerations when selling or contemplating selling a property. And Mark's question's about, a property that ends up converting into an investment property that was previously your home. He said, I'm wondering about how the market value, which is then the cost base, is calculated at the time it becomes an investment property. Is it done by some sort of independent valuer or something similar? And how might an individual think about positioning themselves in the best possible situation? That is, would it be beneficial to maximize that value? Thanks, Mark. So just a bit of a recap and just to sort of frame this question. If we have a property where during part of the ownership period it's been a home and an investment property, there's a couple of different approaches. So firstly, if the property was initially an investment property, and then you go and live in it and then you sell it, or then you rent it out and then sell it, whatever it might be. But if it was originally an investment property, after settlement, you put a tenant in it, then you must apportion the capital gain by number of days. Number of days it was rented out or available for let, number of days you occupied it. And that's how you can apportion the main residence exemption from a capital gains tax perspective. If the property was originally a home when you bought it, so you bought it, you moved in, you lived in it for a few years or whatever it might be, and then you moved out, and then you subsequently, you moved out, rented it for a few years, and then subsequently sold it. The capital gains tax will be the difference between the market value when it was first available for let and what you sold it at. And that's what Mark's question's asking about. How do you determine that market value? Well, firstly, Australia has a self-assessment system, which means the onus is on you, the taxpayer, to demonstrate and prove to the ATO of the value that you used. So the ATO doesn't have to disprove what you've used. The onus of proof relies on you, right? So firstly, you've got to have an audit. Secondly, then they've got to ask for that information. But that's okay. We need to make sure we do have enough information. So there's nothing in the law that says you need to go and pay a valuer or anything like that. You just need to have enough information there. Now, what I would say is that if you're in a pretty buoyant property market, I would go to a real estate agent. I would say, I want you to write a letter and tell me what my property is worth. I want that value to be on the high side. Remember, you're making on the high side to increase your cost base. And they'll write you a letter and say, we think it's worth $1 million and here's the 3 comparable sales that we use to strike that. And the reason I say do that in a buoyant market is because the real estate agent might think, look, okay, all the comparable sales are 900, but I know if we put this property on the market today, I'm going to get north of $1 million. Because in a hot market, prices are moving quickly and the comparable sales won't be enough to sort of support that evidence. So I think going to a real estate agent and getting them to write something like that is probably sufficient evidence, or at least puts you in a position where if the ATO doesn't agree with it, they're not going to argue that, that's been anti-avoidance or anything like that. If you're in a soft property market, then I would use comparable sales. And I would go back and have a look at, if we turn this around and said, I think it's, it would have sold for $1 million 6 months ago, but the market's a bit softer, so it'll probably sell for 900. In that situation, I would go back and have a look at comparable sales over the last 6 months and try and not cherry pick, but rely on the sales that are going to give me a higher sort of cost base or higher market value when I rented it out. You could certainly go and pay for a valuation. You might consider using a bank valuation. If you're doing finance at the time, you get to potentially ask for a copy of the bank's valuation there, but only use that, of course, if it's going to give you a high number. Normally those bank valuations, not always, but normally they're a little bit more conservative, and just compare your own comparable sale research. But I think the real estate agent's letter is probably the easiest and simplest way in order to get that evidence. Great question, Mark, and thanks for asking it. I've got heaps of questions to get through. I will get through them all, I promise. If you have any questions or feedback to provide, the email to use is questions@investopoly.com.au. And until tomorrow, bye for now.